Question 1. Fixed versus variable annuities. Which of the following statements correctly describes the difference between fixed and variable annuities? A. Fixed annuities offer guaranteed interest rates, while variable annuities provide returns based on the performance of underlying investments. B. Fixed annuities have no investment risk, while variable annuities are completely risk-free. C. Variable annuities provide a guaranteed income stream regardless of market performance, while fixed annuities do not. D. Fixed annuities are more likely to provide higher returns than variable annuities because of their guaranteed interest rates. Answer 8. Fixed annuities offer guaranteed interest rates, while variable annuities provide returns based on the performance of underlying investments. Explanation. Fixed annuities provide a set guaranteed interest rate for the duration of the contract. This guarantees the annuity holder predictable payments without exposure to market risk. In contrast, variable annuities involve investments in separate accounts, typically stocks and bonds, which means returns are tied to the market performance. As a result, variable annuities can offer higher returns, but they come with greater risk. Option B is incorrect because both types of annuities carry some level of risk, with variable annuities being riskier due to market exposure. Option C is incorrect because fixed annuities offer guaranteed income, while variable annuities' income depends on investment performance. Option D is misleading as variable annuities generally have the potential for higher returns due to the investments, while fixed annuities offer stability but not necessarily higher returns. Question 2. Suitability in annuity sales. Scenario question. Mr. Adams is 68 years old and recently inherited a significant sum of money. He is considering purchasing a deferred annuity with a 10-year surrender period, which would require him to lock his money in the annuity until he turns 70. Mr. Adams is risk-averse and needs to start taking distributions soon due to his retirement plans. Based on the principles of suitability in annuity sales, which of the following would be the most appropriate course of action for Mr. Adams? A. He should proceed with the purchase of the deferred annuity, as it guarantees him a return over the long term. B. He should consider purchasing an immediate annuity, which allows him to begin receiving income right away. C. He should invest in a variable annuity, which may provide him with higher returns over the long term. D. He should choose an annuity with a shorter surrender period to minimize penalties for early withdrawal. Answer. B. He should consider purchasing an immediate annuity, which allows him to begin receiving income right away. Explanation. In this scenario, Mr. Adams is risk-averse and needs income soon. A deferred annuity with a 10-year surrender period would not be suitable because he would be required to lock his funds for a long period, which contradicts his need for immediate access to funds. An immediate annuity, on the other hand, would begin payments right away, matching his need for income. Option A is unsuitable because a deferred annuity does not meet Mr. Adams' need for immediate income. Option C is also inappropriate since Mr. Adams is risk-averse and may not be comfortable with the market risks associated with a variable annuity. Option D, while it mentions a shorter surrender period, still refers to a deferred annuity, which is not the best choice given Mr. Adams' need for timely income. Question 3. Tax treatment of annuity withdrawals. Which of the following is true regarding the taxation of annuity withdrawals? A. Withdrawals from annuities are always taxed as capital gains, regardless of whether the money is coming from principal or earnings. B. Only the earnings portion of an annuity withdrawal is subject to income tax, while the principal is tax-free. C. All annuity withdrawals are subject to a 10% penalty before the age of 591, regardless of whether they are from a qualified or non-qualified annuity. D. Withdrawals from qualified annuities are taxed as ordinary income, while non-qualified annuities are taxed as capital gains. Answer. B. Only the earnings portion of an annuity withdrawal is subject to income tax, while the principal is tax-free. Explanation. In a non-qualified annuity, one purchased with after-tax dollars, the principal is not taxed upon withdrawal because it has already been taxed. However, the earnings portion of the withdrawal is subject to ordinary income tax. This is consistent with the last in, first out, LIFO rule, meaning that earnings are withdrawn first and taxed. Option A is incorrect because annuity withdrawals are not taxed as capital gains, they are taxed as ordinary income. Option C is misleading because early withdrawal penalties generally apply to the earnings portion of the withdrawal, not the principal, and the 10% penalty is applicable for qualified annuities if taken before age 591, not non-qualified ones. Option D is incorrect because both qualified and non-qualified annuities are taxed as ordinary income, not capital gains. Question 4. Surrender charges and penalties. Which of the following statements best describes how surrender charges work in annuities? A. Surrender charges are typically higher in the first few years of the annuity contract and decrease over time. B. Surrender charges apply only when the annuity is being transferred to another insurance company. C. Surrender charges are the same regardless of how long the annuity has been held. D. Surrender charges do not apply to annuities with a rider for liquidity protection. Answer A. Surrender charges are typically higher in the first few years of the annuity contract and decrease over time. Explanation: surrender charges are fees imposed on the policyholder when they withdraw funds from an annuity before a specified time known as the surrender period. The surrender charge schedule typically starts high and decreases over time, often over a period of 5 to 10 years. This encourages long-term holding of the annuity. Option B is incorrect because surrender charges apply to any early withdrawals, not just transfers. Option C is incorrect because surrender charges usually decrease over time and are not constant. Option D is misleading, as liquidity protection riders may provide some flexibility but do not always fully waive surrender charges. Question 5. Tax deferral. What is the main advantage of tax deferral in annuities? A. It allows the earnings of an annuity to grow without being taxed until withdrawn, increasing the overall growth potential of the annuity. B. It provides a tax deduction for the initial premium payments made into the annuity. C. It guarantees that all withdrawals from an annuity are taxed at a lower rate than ordinary income. D. It eliminates the need for required minimum distribution RMDS from an annuity once the holder reaches age 701. Answer A. It allows the earnings of an annuity to grow without being taxed until withdrawn, increasing the overall growth potential of the annuity. Explanation: tax deferral means that the earnings on an annuity are not taxed as they accumulate. This allows the annuity to grow without being reduced by taxes until the funds are withdrawn, providing the potential for compounded growth. Option B is incorrect because annuities do not provide a tax deduction for premiums. This is only available for certain retirement accounts like IRAs or 401 AKS. Option C is incorrect because withdrawals from annuities are generally taxed as ordinary income, not at a low rate. Option D is incorrect because required minimum distribution (RMDS) still apply to qualified annuities even if tax deferral is in place. Question 6. Annuity riders. Which of the following riders provides the greatest level of protection for the annuitant's beneficiaries? A. Death benefit rider. B. Guaranteed minimum withdrawal benefit double ride. C. Long-term care rider. D. Return of premium rider. Answer A. Death benefit rider. Explanation: the death benefit rider provides the greatest level of protection for the annuitant's beneficiaries, as it guarantees that if the annuitant dies before annuity payments begin, the beneficiary will receive a lump sum that is at least equal to the amount invested or a guaranteed minimum, depending on the terms of the contract. Option B is incorrect because the guaranteed minimum withdrawal double guarantees the annuitant can withdraw a set amount over time but does not provide direct benefits to the beneficiary. Option C is incorrect because the long-term care rider provides benefits if the annuitant requires long-term care but is not designed specifically to benefit beneficiaries upon death. Option D is incorrect because the return of premium rider ensures the return of the premiums paid upon the annuitant's death, but the death benefit rider may provide additional protections, including interest or higher payouts. Question 7. Indexed annuities. Which of the following is a key characteristic of an indexed annuity? A. The returns are directly tied to a stock market index with no cap on the maximum return. B. The returns are based on the performance of a specific portfolio of stocks, bonds, and other securities. C. The returns are linked to a market index, but there is typically a cap or participation rate that limits the maximum return. D. The returns are guaranteed with no risk of loss, regardless of the performance of the market index. Answer: C. The returns are linked to a market index, but there is typically a cap or participation rate that limits the maximum return. Explanation: indexed annuities are designed to provide a return that is based on the performance of a market index like the S&P 500, but they often have a cap or participation rate that limits how much of the market performance is reflected in the annuity's return. This allows the annuity holder to participate in some of the market upside while providing protection against market downturns. Option is incorrect because indexed annuities have caps or participation rates which prevent unlimited returns. Option B is incorrect because the returns in indexed annuities are not based on a specific portfolio of stocks and bonds, but rather on a market index. Option D is incorrect because indexed annuities do have some risk and the returns are not guaranteed to match the market index performance. Question 8. Required minimum distribution (RMDS). Which of the following statements is correct regarding required minimum distribution (RMDS) from annuities? A. RMDS do not apply to qualified annuities that are part of a retirement account like an IRA. B. RMDS must begin by April 1st of the year following the year in which the annuitant reaches age 72. C. RMDS apply only to annuities purchased with after-tax dollars, not to qualified annuities. D. RMDS can be deferred indefinitely if the annuitant is still working at age 72. Answer. B. RMDS must begin by April 1st of the year following the year in which the annuitant reaches age 72. Explanation. Required minimum distribution (RMDS) apply to all qualified retirement annuities, such as those held in IRAs, once the annuitant reaches age 72. RMDS must begin by April 1st of the year following the year the individual turns 72. These distributions are calculated based on the account balance and life expectancy. Option is incorrect because RMDS do apply to qualified annuities, including those held in IRAs or 401ks. Option C is incorrect because RMDS apply to all qualified annuities, regardless of whether they were purchased with pre-tax or after-tax dollars. Option D is incorrect because RMDS cannot be deferred indefinitely. They must begin by age 72, regardless of whether the individual is still working. Question 9. Suitability standards in annuity sales. Which of the following best describes the suitability standard in annuity sales? A. The suitability standard requires that the annuity recommended be in the best interest of the client, regardless of the compensation to the salesperson. B. The suitability standard is based on the client's ability to pay premiums, but not on their financial needs or goals. C. The suitability standard requires that an annuity be appropriate for the client's financial situation, taking into account the client's needs, goals, and risk tolerance. D. The suitability standard only applies to sales of fixed annuities and not variable or indexed annuities. Answer. C. The suitability standard requires that an annuity be appropriate for the client's financial situation, taking into account the client's needs, goals, and risk tolerance. Explanation. The suitability standard in annuity sales requires that financial professionals recommend products that align with the client's overall financial situation, goals, and risk tolerance. This includes ensuring that the annuity is appropriate for the client's age, income needs, investment goals, and ability to withstand potential losses. Option is incorrect because while recommendations must be in the client's best interest, compensation may still influence the suitability standard. Option B is incorrect because the suitability standard considers more than just the ability to pay premiums, it considers the client's financial situation as a whole. Option D is incorrect because the suitability standard applies to all types of annuities, including fixed, variable, and indexed annuities. Question 10. Annuity withdrawal options. Which of the following is a characteristic of the life with period certain annuity payout option? A. The annuitant receives guaranteed payments for life, and if they die early, their beneficiary receives payments for the remaining term. B. The annuitant receives fixed payments for a specific period, and once the period ends, all payments stop. C. The annuitant receives payments for life, but there is no beneficiary protection if the annuitant dies early. D. The annuitant receives flexible payments based on the performance of the underlying investments. Answer A. The annuitant receives guaranteed payments for life, and if they die early, their beneficiary receives payments for the remaining term. Explanation. A life with period certain annuity provides payments for the lifetime of the annuitant with a guaranteed minimum period for payments, e.g. 10 or 20 years. If the annuitant dies before the period ends, the beneficiary continues to receive payments for the remainder of the term. This ensures that the payments continue for a set period, providing a level of security for the beneficiary even if the annuitant dies prematurely. Option A is correct because it accurately describes the life with period certain payout option, which guarantees both lifetime payments for the annuitant and continued payments to the beneficiary if the annuitant dies early. Option B is incorrect because it describes a period certain annuity, which does not include lifetime payments for the annuitant and stops once the specified term ends with no consideration for the annuitant's life. Option C is incorrect because it misrepresents the life with period certain option by suggesting no beneficiary protection, which is an essential feature of this option. Option D is incorrect because it describes a variable annuity payout, which is based on the performance of underlying investments and offers flexibility in payments, but this is not the characteristic of a life with period certain annuity. Question 11. Annuity sales suitability. Which of the following is required for a producer when recommending an annuity to a client under Louisiana's suitability standards? A. The producer must only consider the client's age and income level when recommending the annuity. B. The producer must conduct a full analysis of the client's financial situation, including risk tolerance, investment objectives, and financial needs. C. The producer must recommend the highest commission annuity available. D. The producer must recommend a fixed annuity regardless of the client's financial goals. Answer: B. The producer must conduct a full analysis of the client's financial situation, including risk tolerance, investment objectives, and financial needs. Explanation: under Louisiana law, producers are required to perform a suitability analysis when recommending an annuity. This includes understanding the client's financial situation, goals, and risk tolerance to ensure that the annuity recommended is appropriate for the client's needs. The producer must act in the client's best interest and make transparent recommendations, avoiding conflicts of interest. Option A is incorrect because it only considers age and income, which are insufficient for a comprehensive suitability analysis. Option C is incorrect because the producer must recommend an annuity based on the client's best interest, not commission incentives. Option D is incorrect because the type of annuity recommended, fixed, variable, etc., should be based on the client's specific needs and goals, not a blanket recommendation. Question 12. Surrender charges and penalties. Which of the following accurately describes the purpose of a surrender charge in an annuity contract? A. To allow the annuitant to withdraw unlimited amounts without penalty after the surrender period. B. To ensure that the insurer recovers expenses incurred during the early stages of the annuity contract. C. To provide a bonus to the annuitant if the contract is surrendered early. D. To offset the cost of any additional riders added to the contract. Answer: B. To ensure that the insurer recovers expenses incurred during the early stages of the annuity contract. Explanation: surrender charges are typically applied when the annuitant withdraws funds from the annuity during the early years of the contract. These charges help the insurer recover the costs associated with issuing the annuity, including commissions, administrative expenses, and investment costs. Option is incorrect because surrender charges apply during the early years of the annuity contract, not after the surrender period has passed. Option C is incorrect because surrender charges are not designed to benefit the annuitant and they are a penalty for early withdrawal. Option D is incorrect because surrender charges are not directly related to the cost of riders, but rather to the cost of issuing and maintaining the annuity contract. Question 13. Tax treatment of annuities. Which of the following is true regarding the tax treatment of annuity distributions in Louisiana? A. All annuity distributions are tax-free if the annuity was purchased with after-tax dollars. B. Only the interest or earnings portion of the annuity distribution is subject to taxation. C. Annuities purchased in tax-deferred accounts are always taxed at a higher rate than regular income. D. The entire annuity distribution is tax-free if it is paid to a beneficiary. Answer: B. Only the interest or earnings portion of the annuity distribution is subject to taxation. Explanation: annuities are typically purchased with after-tax dollars, and the distributions are subject to taxation only on the earnings or interest portion. The principal, original investment, is not taxed upon withdrawal since it was already taxed when initially invested. Option is incorrect because annuity distributions are not tax-free. Even if the annuity was purchased with after-tax dollars, only the earnings portion is taxed. Option C is incorrect because annuities purchased in tax-deferred accounts are generally taxed as regular income upon withdrawal, not at a higher rate. Option D is incorrect because distributions to beneficiaries are generally subject to taxation, with the taxable portion depending on the structure of the annuity and the beneficiary's relationship to the annuitant. Question 14. Fixed versus variable annuities. Which of the following best describes the key difference between a fixed annuity and a variable annuity? A. Fixed annuities provide a guaranteed return based on market performance, while variable annuities provide guaranteed payments regardless of market conditions. B. Fixed annuities offer stable returns and fixed payments, while variable annuities have payments that vary based on market performance. C. Variable annuities provide fixed payments, while fixed annuities offer payments that fluctuate with market conditions. D. Fixed annuities are risk-free, while variable annuities are riskier but offer tax-free growth. Answer: B. Fixed annuities offer stable returns and fixed payments, while variable annuities have payments that vary based on market performance. Explanation: Fixed annuities provide a guaranteed interest rate, and the annuitant receives fixed, predictable payments over time. In contrast, variable annuities invest the premium in various securities or funds, meaning the annuity payments can fluctuate based on the performance of the underlying investments, leading to a high potential return, but also increased risk. Option A is incorrect because fixed annuities provide a guaranteed return based on a set interest rate, not market performance. Option C is incorrect because it reverses the characteristics of the two types of annuities. Option D is incorrect because while fixed annuities are considered less risky, they are not risk-free, and variable annuities do not offer tax-free growth. Question 15. Annuity riders. Which of the following is typically considered a death benefit rider on an annuity? A rider that guarantees the annuitant will receive a minimum payout even if the contract's value decreases. B. A rider that guarantees a payout to the beneficiary in the event of the annuitant's death, usually based on a specified value or principle. C. A rider that increases the annuity's payouts based on inflation rates. D. A rider that allows the annuitant to take penalty-free withdrawals for a specified period. Answer: B. A rider that guarantees a payout to the beneficiary in the event of the annuitant's death, usually based on a specified value or principle. Explanation: a death benefit rider ensures that if the annuitant passes away before receiving a certain amount in payments, the beneficiary will receive at least the remaining principal or a minimum value. This is especially important for clients who want to ensure their beneficiaries are protected if the annuitant dies prematurely. Option A is incorrect because this describes a minimum income guarantee, not a death benefit. Option C is incorrect because it describes an inflation rider, which adjusts payouts for inflation. Option D is incorrect because it describes a rider that allows penalty-free withdrawals, not a death benefit rider. Question 16. Market risk and annuities. Which of the following is true about market risk in relation to variable annuities? A. Market risk is irrelevant in variable annuities because the insurer guarantees a fixed return. B. The annuitant assumes market risk in a variable annuity, meaning the value of the annuity and the payouts depend on market performance. C. Variable annuities are risk-free investments because they are invested in government bonds. D. Market risk in variable annuities is eliminated through a guaranteed minimum withdrawal benefit. Answer: B. The annuitant assumes market risk in a variable annuity, meaning the value of the annuity and the payouts depend on market performance. Explanation: variable annuities involve market risk because the premiums are invested in various securities, which may include stocks, bonds, or mutual funds. The value of the annuity can fluctuate based on the performance of these investments, and as a result, the payouts to the annuitant can vary. Option A is incorrect because variable annuities do not guarantee a fixed return of their value and payouts depend on market performance. Option C is incorrect because variable annuities involve risk as they are not invested solely in government bonds and thus the value is not guaranteed. Option D is incorrect because a GMWB may reduce market risk but does not eliminate it entirely. Question 17. Tax implications of early withdrawals. Which of the following best describes the tax implications of early withdrawals from an annuity in Louisiana? A. Withdrawals made before the age of 591 were not subject to tax. B. Early withdrawals from annuities are subject to ordinary income tax and may incur a 10% penalty if taken before the age of 591 were. C. Withdrawals made before the age of 591 were subject to capital gains tax only. D. Early withdrawals are tax-free if the annuity is purchased as part of a retirement plan. Answer: B. Early withdrawals from annuities are subject to ordinary income tax and may incur a 10% penalty if taken before the age of 591 were. Explanation: the IRS imposes ordinary income tax on annuity withdrawals, and an additional 10% penalty applies if the withdrawal is made before age 591, unless an exception applies, e.g., disability or certain medical expenses. This penalty is intended to discourage early withdrawals from retirement savings. Question 18. Annuitization options. Which of the following is the primary difference between a life annuity and a joint life annuity in Louisiana? A. A life annuity provides payments for the lifetime of the annuitant, while a joint life annuity provides payments for the lifetime of two individuals. B. A life annuity guarantees payments for a set period, while a joint life annuity provides payments for the lifetime of one individual. C. A life annuity can only be purchased with a lump sum payment, while a joint life annuity requires periodic payments. D. A life annuity is only available for retirees, while a joint life annuity is available to non-retirees. Answer A. A life annuity provides payments for the lifetime of the annuitant, while a joint life annuity provides payments for the lifetime of two individuals. Explanation: a life annuity provides payments to the annuitant for as long as they live. A joint life annuity, on the other hand, provides payments for the lifetimes of two individuals, typically a married couple. Payments continue as long as one of the individuals is alive, making it a popular choice for ensuring financial security for both partners. Option B is incorrect because it misrepresents the nature of the life annuity. Option C is incorrect because both types of annuities can typically be purchased with either a lump sum or periodic payments. Option D is incorrect because both types of annuities are available to retirees and non-retirees depending on the contract terms. Question 19. Annuity premium payments. Which of the following is most likely to be considered a benefit of making flexible premium payments into an annuity in Louisiana? A. Fixed premium payments are required to maintain the annuity's value. B. Flexible premium payments allow the annuitant to increase or decrease contributions depending on financial circumstances. C. Flexible premiums guarantee a higher payout upon annuitization. D. Flexible premiums eliminate all surrender charges in the annuity contract. Answer B. Flexible premium payments allow the annuitant to increase or decrease contributions depending on financial circumstances. Explanation: flexible premium annuities provide the flexibility for the annuitant to make varying payments over time. This allows the annuitant to increase or decrease the amount they contribute based on changes in their financial situation, which can be a key advantage in managing their retirement planning. Option A is incorrect because fixed premium payments are required for fixed premium annuities, not flexible ones. Option C is incorrect because the payout amount is not guaranteed to be higher with flexible premiums, and the payout depends on the investment performance and the terms of the contract. Option D is incorrect because flexible premiums do not eliminate surrender charges, which apply under specific circumstances in the contract. Question 20. Annuity exchanges. What is a primary consideration for an insurer? When a policyholder requests an exchange of their existing annuity contract for a new one in Louisiana, A. The insurer must ensure that the new annuity is of equal value to the old one. B. The insurer must provide a full refund of the initial premium from the old contract. C. The insurer must determine if the exchange is in the best interest of the policyholder based on the suitability standards. D. The insurer must guarantee that the policyholder will receive a higher interest rate with the new annuity. Answer: C. The insurer must determine if the exchange is in the best interest of the policyholder based on the suitability standards. Explanation: under Louisiana's suitability standards, when a policyholder requests an annuity exchange, the insurer is required to evaluate whether the exchange is in the best interest of the policyholder. This involves assessing whether the new annuity is appropriate for the policyholder's financial situation, goals, and needs. Option is incorrect because the new annuity does not necessarily have to be of equal value to the old one and the focus is on suitability. Option B is incorrect because the insurer does not provide a full refund of the exchange may involve the surrender of the old contract and issuance of the new one based on its terms. Option D is incorrect because the insurer does not guarantee a higher interest rate but focuses on the appropriateness of the annuity for the policyholder's needs. Question 21. Annuity beneficiaries. Which of the following would not be a reason for a policyholder to name a beneficiary on an annuity contract in Louisiana? A. To ensure that the beneficiary receives the remaining contract value upon the annuitant's death. B. To provide the beneficiary with a stream of income after the annuitant's death. C. To reduce the tax liability of the annuitant. D. To designate an individual who will receive any death benefits associated with the annuity. Answer: C. To reduce the tax liability of the annuitant. Explanation: naming a beneficiary on an annuity contract ensures that the designated person will receive the benefits upon the annuitant's death. However, naming a beneficiary does not directly reduce the tax liability of the annuitant. Taxes are generally due on earnings, and the beneficiary may owe taxes on the inherited amount, depending on the annuity structure. Option A is correct because the beneficiary would typically receive the remaining value of the contract after the annuitant's death. Option B is correct because some annuity contracts provide for continuing income to the beneficiary after the annuitant's death. Option D is correct because the beneficiary is the individual who will receive death benefits associated with the annuity. Question 22. Annuity regulation. Under Louisiana law, who is primarily responsible for ensuring that annuity contracts are suitable for the buyer? A. The insurer who issues the annuity. B. The agent or producer who sells the annuity. C. The Louisiana Department of Insurance. D. The buyer, as they are responsible for making their own financial decisions. Answer: B. The agent or producer who sells the annuity. Explanation: in Louisiana, the agent or producer selling an annuity is primarily responsible for ensuring that the annuity is suitable for the buyer. This includes conducting a suitability analysis based on the buyer's financial goals, risk tolerance, and other factors as required by state regulations. Option A is incorrect because while the insurer must comply with regulations, it is the producer's responsibility to ensure the product is suitable. Option C is incorrect because the Louisiana Department of Insurance oversees the industry but does not directly ensure suitability for individual sales. Option D is incorrect because while the buyer has a responsibility to understand their financial situation, the agent has the primary responsibility to ensure suitability. Question 23. Annuity payout options. Which of the following annuity payout options provides a lifetime income to the annuitant but stops paying upon their death without continuing payments to beneficiaries? A. Life-only option. B. Joint and survivor option. C. Period certain option. D. Life with period certain option. Answer: A. Life-only option. Explanation: the life-only option provides payments to the annuitant for as long as they live, but no further payments are made after their death. This option typically provides the highest monthly payout because the insurer has no obligation to make payments beyond the annuitant's lifetime. Option B is incorrect because the joint and survivor option continues payments to a surviving beneficiary after the annuitant's death. Option C is incorrect because the period certain option provides payments for a set period regardless of whether the annuitant is alive. Option D is incorrect because the life with period certain option provides payments for the annuitant's life but guarantees payments for a certain number of years even if the annuitant dies prematurely. Question 24. Annuity application requirements. Which of the following must be included on the annuity application form in Louisiana? A. The annuitant's full medical history. B. A suitability questionnaire that assesses the client's financial situation, investment goals, and risk tolerance. C. A statement from the annuitant's physician. D. A disclosure of the annuity's administrative fees. Answer: B. A suitability questionnaire that assesses the client's financial situation, investment goals, and risk tolerance. Explanation: Louisiana law requires that a suitability questionnaire be completed and included with the annuity application. This questionnaire helps the producer assess the client's financial circumstances, goals, and risk tolerance to ensure the recommended annuity is appropriate for their needs. Option A is incorrect because a full medical history is not typically required on the application form. Option C is incorrect because a physician's statement is not usually necessary unless there is a specific health-related concern. Option D is incorrect because while fees should be disclosed, they are not a requirement for inclusion on the application form itself. Question 25. Market Value Adjustment (MVA). Which of the following best describes a market value adjustment (MVA) provision in an annuity contract in Louisiana? A. It guarantees that the annuity's value will remain constant over time, regardless of market conditions. B. It adjusts the annuity's value based on changes in interest rates when the annuitant withdraws or surrenders the annuity before the contract period ends. C. Ensures that the annuitant receives the highest possible return on their investment even if market conditions decline. D. It provides a bonus to the annuitant for holding the annuity for a specified period. Answer: B. It adjusts the annuity's value based on changes in interest rates when the annuitant withdraws or surrenders the annuity before the contract period ends. Explanation: an MVA provision allows the insurer to adjust the annuity's value based on the prevailing market interest rates when the annuitant makes a withdrawal or surrenders the contract before the end of the term. This adjustment can either increase or decrease the contract's value depending on market conditions. Option A is incorrect because the MVA provision does not guarantee a constant value. Option C is incorrect because it does not provide a guaranteed return, only an adjustment based on market conditions. Option D is incorrect because the MVA does not provide a bonus but adjusts the value based on interest rate changes. Question 26. Premium payment mode. In Louisiana, which of the following best describes the premium payment mode for an annuity? A. It determines the frequency and amount of payments made to fund the annuity contract. B. It specifies the beneficiary designation of the annuity contract. C. It dictates the annuity's payout duration, such as lifetime or fixed period. D. It ensures that the annuity provides a fixed interest rate for the duration of the contract. Answer A. Determines the frequency and amount of payments made to fund the annuity contract. Explanation. The premium payment mode specifies how often the annuitant will make payments into the annuity, such as monthly, quarterly, or annually, and the amount of those payments. Option B is incorrect because the premium payment mode pertains to payment frequency and amount, not beneficiary designation. Option C is incorrect because it refers to payout options, not the payment mode. Option D is incorrect because the premium payment mode does not dictate the interest rate, but rather the payment structure. Question 27. Taxation of qualified annuities. Which of the following is true regarding the taxation of qualified annuities in Louisiana? A. The annuity's entire payout is subject to state tax and federal tax. B. The entire amount of the payout is tax-deferred until the annuitant begins taking withdrawals. C. The principal portion of the annuity payout is taxable while the earnings portion is tax-deferred. D. The entire annuity payout is tax-free if purchased with tax-deferred retirement funds. Answer B. The entire amount of the payout is tax-deferred until the annuitant begins taking withdrawals. Explanation. Qualified annuities, which are purchased with tax-deferred retirement funds such as IRAs or 401(k)s, defer taxation on both the principal and the earnings until the annuitant begins withdrawing funds. Option is incorrect because the payout is not taxable until withdrawn. Option C is incorrect because the earnings, not the principal, are taxable upon withdrawal. Option D is incorrect because the payout is taxable when withdrawn, even if purchased with tax-deferred funds. Question 28. Required Minimum Distribution, RMDS. Which of the following describes the impact of Required Minimum Distribution, RMDS, an annuity contract in Louisiana? A. RMES apply only to annuities purchased with after-tax dollars. B. RMES are required for annuities purchased within retirement accounts starting at age 72 or 73, depending on the year. C. RMDS do not apply to annuities purchased within qualified retirement plans. D. RMDS can be postponed until age 75 for annuities purchased within retirement plans. Answer B. RMDS are required for annuities purchased within retirement accounts starting at age 72 or 73, depending on the year. Explanation. Under federal law, RMDS must begin for annuities purchased with tax-deferred funds once the annuitant reaches age 72 or 73, depending on when the annuity was purchased. These distributions are mandatory to ensure that tax-deferred funds are eventually taxed. Option is incorrect because RMDS apply to qualified annuities purchased with tax-deferred retirement funds, not after-tax dollars. Option C is incorrect because RMDS do apply to annuities within qualified retirement plans. Option D is incorrect because RMDS cannot be postponed past the required starting age. Question 29. Annuity death benefit. Which of the following best describes the death benefit option in a Louisiana annuity contract? A. It guarantees that the annuitant's beneficiary will receive at least the amount of premiums paid into the annuity minus any withdrawals. B. It ensures that the annuitant's beneficiary will receive a lump sum equal to the total amount of annuity payouts made to the annuitant. C. It provides a return of premium feature, but only if the annuitant dies within the first year of the contract. D. It guarantees that the beneficiary will receive a fixed monthly income similar to the annuity payouts. Answer A. Guarantees that the annuitant's beneficiary will receive at least the amount of premiums paid into the annuity minus any withdrawals. Explanation. Many annuities offer a death benefit that ensures the beneficiary receives at least the total premiums paid into the annuity, adjusted for any withdrawals or other distributions if the annuitant dies before the annuity begins paying out. Option B is incorrect because the beneficiary does not receive a lump sum of all payouts but may receive a death benefit based on premiums paid. Option C is incorrect because the return of premium feature typically applies throughout the contract, not just within the first year. Option D is incorrect because the beneficiary typically receives a lump sum rather than ongoing payments unless the contract specifies a different settlement option. Question 30. Annuity surrender charges. Which of the following is true regarding surrender charges in an annuity contract in Louisiana? A. Surrender charges only apply if the annuitant withdraws more than 50% of the account balance. B. Surrender charges are imposed when the annuitant makes withdrawals or surrenders the annuity within the early years of the contract, C. Surrender charges are fixed and do not decrease over time. D. Surrender charges are not allowed under Louisiana law. Answer B. Surrender charges are imposed when the annuitant makes withdrawals or surrenders the annuity within the early years of the contract. Explanation. Surrender charges are designed to discourage early withdrawals and are typically applied during the initial years of an annuity contract. These charges decrease over time and are generally lower in later years. Option is incorrect because surrender charges can apply even for smaller withdrawals, not just those exceeding 50% of the balance. Option C is incorrect because surrender charges typically decrease over time, often disappearing after a certain number of years. Option D is incorrect because surrender charges are allowed, but they are regulated under Louisiana law.